Hey guys, Colin here with Main Street Wolf, and today we are going to be talking about taxes. Taxes, yes, exciting stuff. The GOP just passed their final tax plan. They've kind of taken the combination between the House of Representatives version and the Senate version and made a final plan. It recently just got passed, so it is kind of a big deal just because it affects everything we do in this economy. It affects individuals, it affects businesses, it affects everything. I thought it'd be cool to talk about, and keep in mind that this plan just passed and it will not affect the 2017 tax filing. It won't be effective until January 1st of 2018. I first went online to see if I could find a version or a PDF file of the tax bill, just because I was curious if I could read it. And I did find it, and after doing some investigating, it turns out that the document's 570 pages. So needless to say, I didn't want to read that. I went ahead and found this amazing article on CNN that has 16 points that pretty much summarizes anything that has changed in a major way compared to the current tax code. So we're going to kind of go over each point, and everything that I talk about, reference in this video, I will link below. So I'll link the article as well as the calculator and other links that I've referenced in the video. So to start off, everyone as an individual filer, or in most cases, are getting a lower tax rate. Whatever tax bracket you're in, 6 of the 7 tax brackets have a reduced rate, and that will overall reduce everyone's income tax, therefore saving you a little bit of money. You can see that 10%, 10%, 12%, 15%. Oh, one thing I will go into, just in case if you have no idea how taxes work, but let's say, for example, you make $45,000. Let's see how you should read these tax brackets, because there's sometimes a confusion with how much taxes am I paying on that $45,000. If you looked at this and you're saying, oh, over $38,700 as a single filer, I'm going to be paying 22% on that. And that's incorrect, because really taxes it's kind of staggered, right? For the first $9,525 that you make as an individual, it's taxed at 10%. Then everything that's between $9,525 to $38,700, 12%. And then whatever's over the $38,700 is what you're paying 22%. So you kind of combine everything and you'll see that you have a different effective tax rate than that 22%. But overall, the tax rates are being lowered for individuals. So this is something, point number 2, nearly doubles the standard deduction. For single filers, it's going to be $12,000. For married couples, it's going to be $24,000. And that's a pretty big jump from what it's currently today. It's almost double the amount. What this is going to do is most people will end up taking a standard deduction instead of going through and itemizing their deductions, just because in the end, whatever's higher, you're going to pick the one that saves you the most in taxes. So that's kind of what the plan is trying to do. They're trying to make it so more people pick the standard deduction instead of going ahead and itemizing. One thing that does hurt people is that the new tax plan eliminates personal exemptions. And so today you're allowed to claim $4,050 for yourself, your spouse, and each of your dependents. And without this personal exemption, it's definitely going to hurt people that have a lot of dependents, because that was pretty nice. And let's say you have a bunch of kids, by getting a reduction in your taxes by $4,000, that definitely helps, and they completely got rid of it. Sure, they have the tax credit for children, but getting rid of the deduction as well definitely hurts people with kids. So sorry if you have a bunch of kids, that kind of sucks. Another thing that they are changing is they're capping the state and local tax deduction, which is part of itemizing. So what's going on here is they're capping the amount that you can deduct from, I guess it's called the SALT, state and local taxes and property taxes. You're going to see that you can't deduct anything past the $10,000. So what this really means is it kind of hurts people that live in states that have high state taxes, high local taxes, high property taxes, just because in the past you were able to write off the full amount. And usually if you itemized, you would get the higher amounts, and you would obviously pick that over the standard deduction. But now that they're capping it, people may end up having to pick the standard deduction and not get the benefit of lower taxes. They are changing the child tax credit. They're doubling it to $2,000 for anyone that's under 17. Like I said, with the personal exemptions, that was a deduction. In a way, it kind of offsets with the tax credit, but at the same time, you used to get both, right? You used to get the exemption of $4,000 plus $1,000 for each kid. And this is a tax credit. So this is, let's say your tax liability is $4,000 and you have one kid. Instead of paying the $4,000, you're only going to have to pay $2,000. I guess also it's good to mention that if you do have a tax liability that is zero, you can potentially still get a refund from the government of $400. Creates temporary credit for non-child dependents. You also can receive a credit for people that are over 17 and you're still taking care of them, whether that be an elderly parent or someone with a disability. Lowers cap on mortgage interest deduction. If you're a homeowner and you're going to purchase a home and take out a mortgage on that home, you won't be able to deduct the interest unless, well, you'll be able to deduct the interest on mortgages up to $750,000. If you're a homeowner in some high cost of living area and all the real estate is super expensive, you're not going to be able to deduct that interest on your mortgage, or you're capped. And also homeowners that already have a mortgage will not be affected by the change. So it's anyone that's purchasing a home in the near future. Another thing, curbs who's hit by AMT. And if you're wondering what AMT, I was also wondering what AMT is. It's the alternative minimum tax. What this does and why it was created, I looked into it. It was a way to make sure that people that found tax loopholes and was able to reduce their tax liability to basically nothing, but they were also super well off. They created this tax rate that you also have to calculate. And if your tax rate that is calculated from the alternative minimum tax is higher than your other tax liability that you calculate, you have to pay the higher of the two. Just a way for people with a high income that find ways to reduce their tax liability in the normal tax code to not have to pay as much. They also have to calculate this alternative minimum tax to figure out if, hey, do I have to pay this amount compared to this tax liability I calculated from normal taxes, basically nothing. The earlier bills called for elimination of this tax, but the final version keeps it. They did raise the income exemption, though. That means if your adjusted gross income is less than the $70,300 for singles, you don't even have to try to calculate the taxes for your alternative minimum tax. Number 9 is preserve smaller but popular tax breaks. We saw an early version of bills proposing to get rid of things like deductions for medical expenses, student loan interest, and like even classroom supplies bought with the teacher's own money. Another big one was tax-free status of tuition waivers for graduate students. It seems like they're really going for making college even more expensive, just because if you get rid of student loan interest, I was thinking about this, and let's say you come out of school as like a doctor and you have $500,000 in student loans and you're paying $50,000 a year on just interest alone on these student loans. You wouldn't be able to deduct that at all. That's just something you'd have to pay, and you'd still have to pay taxes on whatever income that you're making. And then also like the tax-free status of tuition waivers for graduate students. Let's say your tuition is like $50,000, and by working as a graduate student, you don't have to pay anything. They would consider that $50,000 in tuition waivers as taxable income. As a graduate student, you wouldn't even be working, right? Or you may be doing things like, working for the university and doing teacher's aid stuff. You might be helping out in a classroom, but you'd have to pay taxes on the tuition waivers that you receive, basically the scholarships, which would suck. They actually kept these things in there and didn't screw over everyone in that portion of the bill. Number 10 exempts most everybody from the estate tax. This doesn't really affect too many people unless you're super loaded and you have a giant estate. They doubled the amount from, you have an estate that's over $5.49 million. I think it's like 11 million now, essentially, that you're going to have in order to be taxed on it. So anything over like the $11 million would see the estate tax. Everything else would be tax-free. This one was kind of interesting to read. Number 11, slows inflation adjustments in tax code. And so what this really means is that by giving us a slow adjustment in the tax code for things like the standard deduction, let's say hypothetically, I'm making $80,000 a year, and then the next year inflation goes nuts and I'm making $100,000 a year, but my purchasing power has not increased at all. The $100,000 is 100% just inflation-based raise, but my standard deduction hasn't changed at all. So in the year I was making $80,000, I get a standard deduction of $12,000. I'm making $68,000 a year, or adjustable gross income is $68,000. So I have to pay taxes on that $68,000. Let's say in the next year I'm making $100,000, but my standard deduction hasn't changed at all. It's still $12,000. So now instead of paying $68,000 in taxes, I'm paying $88,000 in taxes. So you can see that I kind of get ripped off because under the tax code I will be paying more in taxes, but my purchasing power hasn't gone up at all. So that kind of sucks. Number 12, eliminates mandate to buy health insurance. So with Obamacare and under Obama, everyone was required to have health insurance, and if you didn't, you had to pay a penalty. So now they're getting rid of that clause, and essentially less people will be signing up to buy insurance because there isn't a penalty. You can see here they're predicting less people will sign up and enroll in programs, and the government won't have to pay as much in insurance subsidies and Medicaid. One thing it does hurt, though, is anyone that is buying the insurance through these programs, because, well, I guess the people that are healthy will not be encouraged to buy insurance and just risk it, not have to pay insurance because they don't have to pay a penalty, and everyone that's in that insurance pool will be considered unhealthy, so their premiums will go up. Because if you're bringing in healthy people into this giant pool of insurance, everyone's premiums come down. When the insurer is handing out these premiums, if you have healthy people paying in, then they don't have to worry about paying out for the people that are unhealthy, just because they're cashing these premium checks from people that are healthy but never actually using the benefits. Pretty much sums up for individual filers what effects the GOP plan will have. If you're watching this video and you only care about the individuals, you can stop watching. Thanks for watching. Hopefully you found this enjoyable. Like I said, all the links down below, you can find all the references that I'm talking about in this video. But now let's talk about business and corporations, because this is where we're seeing huge changes in the tax code. And if you own a business or you're a corporation, you're making out like a bandit in this new tax plan. As you can see as we continue to read through the last couple points here. So number 13, lowers tax burden on pass-through businesses. So something that's new, if you're in an S corporation, LLC, partnership, you're able to reduce your taxable income by 20%. So you're making, and then obviously it's phased out, but if you're making $157,500 as a single filer, you'd be able to reduce that taxable income by 20%. And then 14 includes rule to prevent abuse of pass-through tax break. What they don't want people to do is essentially withhold their wage income, which doesn't get this deduction from a business, and basically get all of their money from the profits, which would flow through, and they'd be able to reduce that income by 20%. So let's say, for example, I make $100,000 in business profit, and I pay myself a $50,000 salary. What I could do, I get 20% reduction on the 100,000, but I don't get a 20% reduction on the 50,000. Instead of paying myself $50,000, why not just give myself a salary of $0 and pass through that considered an expense on the business, and I collect $150,000 in business profits, which is all going to me, but instead of getting a 20% on 100,000, I get 20% reduction on 150,000. They're trying to prevent this by saying if you also draw a salary from the business, that money would be subject to ordinary tax incomes or ordinary tax rates. So, but people always try to game the system and find loopholes. Number 15, slashes corporate rate. And this is big. You can see that we're going from 35% at a corporate tax rate to 21%. It's a 14% reduction. And for businesses that are bringing in tens of billions of dollars in profit a year, you're seeing savings of $1 to $2 billion in taxes. The hope of the U.S. government, they're hoping that businesses will take this $2 million and invest back in the company, increase wages, hire more people, invest in U.S. assets, get more economic activity, just because businesses will have more money to spend because they're not having to pay taxes. Now, what they don't realize is that companies could, instead of investing in the U.S., they could potentially just take that money and give it right back to their investors. They could say, hey, I don't want to have to, we got this tax savings, $2 billion, we could just release a one-time special dividend and all the investors will get a windfall, which is possible. Then this whole tax bill basically takes the money that the corporations are making and paying into the tax system and giving it to the people that are already rich and own a lot of companies within the stock market. I don't know how it's going to play out, but that's a possibility that the whole point of this bill, reducing the taxes to increase hiring and all that, kind of backfires. Trickle-down economics. We'll see if it works. 16, change how U.S. multinationals are taxed. With this portion, they're saying that there's a lot of money out in the world that has not been brought back by these multinational companies such as McDonald's or Apple because they don't want to be taxed on the money. And so they'd rather just leave the money overseas, and whether that be just a cash reserve or a way to keep that money and invest it overseas, they don't want to bring it back because they consider that money, they don't want to be taxed the high percentage. So what they're doing is they're coming with a one-time low tax rate for overseas profits, hoping to bring that money back into the U.S. and once again hire more people, increase wages, all that good stuff to get the U.S. economy going. We'll see if that works too. So that's pretty much everything that's highlighted. Like I said, if you do want to calculate how it affects you, this new tax plan, I also found this GOP tax plan calculator. It's pretty great. You just put in all of your info on, single, all your deductions, if you're going to take a standard deduction, and it kind of figures out how much you're going to be paying less compared to if the taxes didn't change at all, or if you're going to be paying more. Thanks guys for watching. If you did enjoy this video, please consider giving it a thumbs up and subscribing to Main Street Wolf. Personal finance, tech, pretty much anything to do with money I talk about on here. Have a good day, and thanks again for watching.